Hello, everybody, and welcome back. Today, my guest is Patrick Zweifel, Chief Economist at Pictet Asset Management. We want to discuss recent trends and development in Chinese financial markets. Welcome, Patrick.
Thank you very much for having me. Good morning, good afternoon, everyone.
Patrick, international investors have recently withdrawn a lot of capital out of China, partly because of the unlimited friendship with Russia. Do investors need to reassess political risks in China?
Very good question indeed. Looking at the latest flows or portfolio flows into China, I think we really had a lot of outflows coming during the months of March and April. So around 12 billion on equity, around 80 million on bonds, but that has actually totally returned on or reversed on the equity side, while a bit less so on bonds. So I think that dramatic move is has been less important, and in particular because the risk that you mentioned, so reassessing the political risk, has been the first driving move following the Ukraine war crisis, but then had been reassessed. And I think in a right way that China is not Russia and is completely different from it, because it's much bigger. It's much more integrated into the world, and China wouldn't be able to afford the kind of sanctions that Russia has been facing, and the rest of the world wouldn't be able to actually implement the same kind of sanctions. So totally different risk there.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. China's COVID-19 policy is weighing on the global economy via disruptions in global supply chains. So how will this affect China's growth plans for 2022?
We already had Chinese GDP for the second quarter, which was essentially the period during which these restrictive measures have been implemented in China. So it contracted by more than 2%, close to 10% annualized in the second quarter. So, and the trough was roughly during mid-May. So we've already seen a recovery in most business cycle indicators. Just to mention a few, we had like a rebound of more than 20% on residential spaces transactions. We already had a rebound in industrial production, retail sales, car sales almost doubled. So the recovery is there, and we're likely to see the same kind of rebound in Q3, or mirroring the decline that we had in Q2. So now what we may imagine as well is that the COVID measures will remain in place, but they will be dynamic over time, like they've done, moving from absolute zero to more kind of dynamic zero. So less restrictive than it had been in the past.
Inflation, skyrocketing commodity prices, and rising interest rates are keeping financial markets busy. So how will China's central bank counter this situation during the next, let's say, 6 to 12 months?
Yeah, so I guess China is in total different business cycle than the rest of the countries. So the inflation is still very low, 2.5%. So for the consumer price index, they've got low growth, so no overheating problems there, obviously. So what we may expect is obviously more accommodative economic policies. But as we all know, China monetary policy is also very much different from the rest of the world. They tend to focus more on quantity rather than price. So they are unlikely to move interest rates a lot, but they're more likely to boost credit and credit quotas, notably by allowing local government bonds issuance to be more important in the second half. That would be the major stimulus that we may expect from there.
The opening of financial markets brings inclusion in global indices. So how far has China come on its way of liberalization of financial markets?
Well, so if we talk about the long story, they've made huge progress, obviously. So they always wanted to first liberalize interest rate markets. So essentially starting by domestic reforms before addressing the currency and the FX market. So interest rates have been liberalized. Now on the FX side, and especially the capital account opening up and liberalization, or the inbound or the inflows have been totally liberalized. So for an external investor, it's totally free to actually invest in Chinese financial assets. But on the outbound side, so essentially Chinese being able to invest abroad, there are still many constraints there. So we still maintain the renminbi not a fully convertible currency, and that's the main obstacle that we still have in this liberalization process and on this long path towards a more international renminbi and more dominant currency.
Are we likely to see a halt or even a reversal of financial markets liberalization in China due to the current tensions with the US?
Well, in my view, that's totally unlikely. So what we've seen following the COVID is more protectionism. Countries want to be less vulnerable to supply chain and all this kind of thing. So there might be some more protectionism in specific sectors, such as medical supplies, IT. But that's extremely likely to be limited to those sectors. And otherwise, I would continue to expect China and global flows to be important, especially companies still wanted to be close to China's demands, and so still wanted to invest in China to basically sell their goods to Chinese customers.
In view of China's special position, you and your team argue for a separate China equity or China bonds asset class. So to what extent is China different from other emerging markets?
I guess three main factors. First one is, well, China is so big that it's extremely likely to become a core holding in the future, similar to the US. Second, I guess China is usually a different business cycle than other economies, so and especially emerging markets. And this is exactly what we are experiencing right now. So it would make sense to have it in a different index, or being able to invest separately into Chinese markets. And the third, which is probably more emotional, is that there are a lot of investors who actually do not want to have any exposure for whatever reasons to Chinese assets. And that would make a lot of sense to have that market separate from the rest of EM.
China's local currency fixed income market is huge, but it's also dominated by the huge real estate sector. What is the case for local China bonds currently, and where do you see investment opportunities in the current environment?
I think the first, again, long-term supporting factors are clearly the size of Chinese markets. Chinese debt, second largest in the world, but still largely under-owned. So less than 3% of foreign investors are actually holding Chinese debt. So that's still very low. It's very defensive, diversifier. As I mentioned, China is a net credit country, similar to Switzerland or Japan. So it makes it very different from other market as well. So it should have low volatilities, has low correlation. And I mentioned as well the different business cycle that China usually has. So it makes a lot of sense to actually hold Chinese local bonds. Why right now? But because again, we talk a lot about financial deleveraging. So they've been taking this risk of over leveraging very seriously a few years ago, and that's still the trend. Real estate sector, you mentioned it, was a big issue last year. I guess the trough has been reached probably in mid-May this year. So better outlook on that specific sector as well.
So this was Patrick Zweifel, Chief Economist at Pictet Asset Management. Thank you very much, Patrick, for being with us today and sharing your views on China.
Thank you very much for having me. Have a good day.